Hi, this is Rick Petrocelli from Morpheus Trading Group, and in today's video we're going to show you how we use ATR, average true range, to identify setups that fit well within our trading strategy. For those who do not know, ATR is average true range, which is simply an indicator that gauges a stock's volatility over X amount of trading days. We typically use 20 days. But you can use 14, use whatever you're comfortable with. Now, for example, Disney has an ATR of a 20-day ATR of 1.23 points. And that's its average range over a 20-day period. Now, what we do is when we are scanning, right away we want to weed out the stocks that do not fit into our style of trading. And just a quick overview on what we do. We're a short to intermediate term swing trading group that we focus on trading with the trend of the market. So when the market is in an uptrend, to us that's time that can't be wasted. We want to find as many stocks as we can to buy while the market is going higher. We want to rotate in and out of names quickly so we can maximize returns and minimize our risk. Now, it would be pretty hard to do this if we were to only trade stocks like Disney, because Disney trades at, and this is our simple indicator we've created that basically divides the price by the ATR. Disney trades at 59 times its ATR. So most stocks on average trade 40 times their ATR. Many ETFs will trade 60 and 70 times their ATR. And some bond ETFs will even trade over 100 times their ATR. The lower the number, the better. So while Disney is at a 60, many stocks are at 40. Some stocks, like we'll see soon, like Solar City, are in the 20s. So what this allows me to do is, one, when I set up a scan in TC2000, I can right off the bat eliminate any stocks that are slower than I like. And just to go back to the portfolio management side of it, if you have a 100K portfolio and you have 10 slots in that portfolio that are open for trades, if a stock like Disney were to take up 10,000 and it moves slow and takes maybe 6 or 7 weeks to go up 15% max, 10 to 15%, you could have had a stock that was a little bit more exciting, was a little bit more volatile, that traded maybe 25 or 30 times its ATR, and that could run about 15 to 20% in 2 weeks' time. So within our trading system, it's important to find stocks that have the potential to explode 15 to 30% higher over a 2 to 4 week period. So, for example, that would be a stock like Solar City, which trades at 18 times its ATR. This is a stock that if we were to put in our portfolio, we could expect it to run, 20 to 30% in 2 to 3 weeks, as it's done here in the past. Now, I know some of you are thinking, to have 10 Solar Cities in my portfolio would be a little bit too much. And yes, you should always trade what you feel comfortable with. So if you don't feel comfortable taking stocks that are as explosive as Solar City, maybe you could take on 3 or 4 out of your 10 position portfolio that are explosive and have a few that are at 40 and a few that are at 50 and slower. But again, our goal is to find stocks that are ready to go right away and that have the ability to move 20-30%, because we want to maximize our gains while the market is in rally mode. So the quicker we can rotate in and out of names, the better off we are. So as you can see, volatility plays a big part in what we do with our trading strategy. And just because we're buying stocks that are more volatile doesn't mean that we have these extremely wide stops. We do look for volatility contractions to purchase these stocks. We're looking for stops that are anywhere from 3 to 8% wide. If you'd like to know more about our style of trading, you can go to our blog at www.morpheustrading.com/blog/. And you can also go to morpheustrading.com. Thanks for joining me and have a good one.